The four horsemen of the investment apocalypse are fear, greed, hope, and ignorance. And only ignorance is something that you can address.
I saw some of these folks, they lose everything in a day. Lehman stock goes to zero, they lose their house, they get divorced. As a venture capitalist, your job is to serve your three bosses, the entrepreneurs, your clients, and your colleagues. That is it. That is your job. You don't need to be right every time to dominate or be fabulously successful. If you can't reverse a position, then just go to the sideline. It's just a lot better than bleeding. I realized that my judgment is the only one that matters for a particular trade idea, because everyone's fallible, and to some degree or another, we're all groping in the dark.
Well, hello, everybody. It's Jim O'Shaughnessy with yet another Infinite Loops. Now, today's guest, I have really had to coax on to the podcast, is my friend Ateet Ahluwalia, who runs a hedge fund, or VC fund, rather, the founder of Island Green Capital Management. Now, why did I have to coax you on here, Ateet? And welcome.
Thank you. I think for me and what I do in venture, when you're constantly trying to service the entrepreneur, your teammates, your LPs, you really have to be in a position to not want the glory, right? If you're helping an entrepreneur, you want to make sure that they dictate the narrative. In venture, they have investors that sit on the cap table that take board seats, and they're effectively your boss. They're thinking, well, can she let us to the C? Can she lead us to the D in the IPO? So me speaking about anything in general to do with the business, I'm always a little bit reluctant to do, because flying under the radar is our calling card, essentially. And if you don't want the glory, there's so much you can learn, so much you could do, and so many great companies and investment themes you can be a part of. So that's probably why. Also, personality-wise, I just kind of like reading and being a nerd and getting lost in my spreadsheet, or doing the on-site visits in the factory in Wichita, Kansas, or wherever the business takes me.
You and I have had some great conversations about something that we both think a lot about. And that is this idea of how do we approach risk? How do we approach risk management? We're going to talk about some of the lessons you learned when you were at Goldman. But we have very similar views on that. One of your quotes is, ironically, in a changing world, playing it safe is one of the riskiest things you could do. And I've often said that in the short term, the investment which appears to be the safest, like, say, T-bills, is in the long term, the riskiest investment you can make. So let's dive into that.
Yeah. The thing you're trying to avoid usually becomes the thing that happens, because it's at the forefront of your mind. And because you think about it all the time, the human mind has this unique ability to manifest what it thinks of most, whether that be good or bad. But particularly if it's something you're trying to avoid. When people think of T-bills, of course, they pay you an astronomical amount relative to the recent past, zero and low interest rates. But, if you look at someone like Larry Summers, right? Treasury Secretary under President Clinton, well-respected guy across circles. And even he tweeted out that, hey, if you measured inflation the way we did, it peaked at 18%, and it's coming below 6% now. So your 5% on your T-bill, while attractive relative to recent past, maybe on a real basis is not attractive at all whatsoever. And so I think people need to really think about what the real nature of the risk they're taking is. And I guess one of the best lessons I learned was during the crisis in Zimbabwe. Do you remember those $100 trillion notes and things of that nature?
I do.
During the yeah. So I had a buddy that worked next to me, and he was from Zimbabwe. And I asked him, like, oh man, things must be awful. Like, I hope your family's okay. Like, anything I can do? And he kind of laughed, and he's like, man, everything's great. I'm like, I don't understand why you would say that. Or I thought he's making fun of me, or just, something's happening. And he goes, dude, when you can see a hyperinflation coming, people like us will take out loans, and we will buy prime real estate, and then we will pay them back with this $100 trillion note sitting on my desk here. So my family got to really, triple the size of its land holdings and real estate holdings, because we've seen how this movie ends. And that was such a wild lesson to me, because if you thought hyperinflation was coming, maybe you'd buy gold. Maybe you'd buy stocks or assets in other countries. But you could have. There's many iterations and expressions of the trade for what safety really is. And if you have a home bias or you can't actually invest outside of your own home country, a lot of counterintuitive things happen at the extreme, at the limits of finance.
Let's talk about some of them because I've seen this pattern time and time again. I love that story about your friend from Zimbabwe because what one of the things that both you and I do is look at things, from a different perspective, I guess, would be the way to put it. And like the precautionary principle, which rules so many societies. If you do your homework and you look at the most tightly wound precautionary principle above everything else, right? Like we can't take this risk because, and it's so easy to fill in all of the reasons. It's really easy to find things not to do something. And I also completely agree with your analysis of whatever you are spending all your time thinking about. It's like, don't sit there and think, don't let my portfolio go down, lead me to ruin. Don't let my portfolio lead me to ruin. Guess what? The universe is going to say, oh, he wants his portfolio to lead him to ruin. Okay, that's what we're going to do.
Every single time, yeah.
And so let's talk about how you look at risk in particular, because it's very different than the way even your average venture capitalist or average hedge fund manager looks at it.
Yeah, I think for me, risk is not really a question of should or should not. It's a question of size. Because the sizing of a particular position will dictate your ability to hold it. And then the next layer is what gels with your emotional constitution, and that will dictate the expression of the trade. There are occasions where you can buy in the money options in a stock that you like, and you can, maybe a stock's $10 and you buy a $7 call. Well, there's $3 of intrinsic value, and maybe there's a couple cents or maybe $1 over. Well, if you think there's going to be a big move, but you also think there could be a big drop, there's a way to risk only $3 and a bit on a $10 stock that you think could really motor. And you can either cut the amount of upfront invested capital through that strategy, or you can simply do 3 times as much or however much you want to lever at that point. I think a lot of times people will just think, hey, I'm taking less risk because I'm buying an out of the money call, but the implied to realized differential is so high that they're overpaying in NVIDIA earnings when it was breaking out above 100 and split adjusted. I think the implied move is something like 12%. So there are times to play options. There are different structures that one could take. But I think that when one's looking at price risk in just that dimension, you really need to understand what your personality can tolerate from a risk standpoint that will allow you to do the right thing continuously. Then it becomes a question of, okay, that's the price risk, but what about counterparty credit risk? What about other risks in terms of the Greeks? What about risk when it comes to how that impacts the rest of your portfolio? Do you really just have the same trade 3 different ways? If you buy 3 semiconductor stocks and you think you've, diversified your NVIDIA risk with AMD and Broadcom, you should probably have a conversation about that. You're tripling. But I really think about the expression of the trade probably way too much to see what's optimal. And then I spend even more time thinking about, or have historically, what gels with my personality. And that's a function of the things I saw in the crisis.
Yeah, that is something that when I started out, I was a real proselytizer, right? It was like, here is the way you need to invest. Listen to me. I shall tell you all. and then I realized what a fuck up I had been maintaining that attitude. And your idea is the one I have come to fully express for investment. The key thing investors need to get right is what is right for them and their personality, right?
Yeah.
Like, I love ball. I will go, people around me think I'm absolutely fucking out of my mind, but I love ball. And so I perceive these things very differently than other people. And as I've talked to more and more, both end users, right? So not professional investors, but also with professional investors, I realize okay, what an idiot I was to suggest that this was the one true way. Because if you can't put a strategy into action, or if you can only do so in kind of a hit or miss way,
Yeah.
your results are going to be really poor. And so let's talk about, like, for our listeners and viewers, how would you walk somebody through kind of getting to the essence of, hey, here's what I think I can handle in terms of risk, return, et cetera?
Man, that's a great question. There's two sides of that coin. There's how you feel about your process and how it gels with you. And then there's how you deal with success. I don't know if you remember Ed Sakota. He said, everyone gets what they want out of the market. So if what you wanted was attention because you failed, you'll definitely get that. If you want riches beyond belief and you probably put in the hard work to do it, you probably get that too. But I think how you deal with yourself and then also how you deal with winning is the other side of the coin. For me, I got lucky in in 2008. I think I was 24 years old. They just let go of the head index trader at Goldman. They brought me and another senior trader over. So I went from putting out trade ideas that no one read to being a part of the biggest risk book, one of the biggest risk books in Europe. The guy next to me ended up leaving after a few months for personal reasons. And, you're kind of there on your own. And the luck is there's no way on earth that would happen today. You're not giving a 24-year-old a several $100 billion book and saying, hey, go prop trade that, have at it. Equally, they had to have had enough risk going on macro-wise for them to not really think about my age, but just to say, is he producing? Is he thoughtful? Can we trust him? And so a lot of luck involved in that. But within that, a lot of lessons were learned around the emotional constitution required to trade. And then also how I thought about it. There were heroes of mine that I idolized that were just unbelievably intelligent. And every day was a joy because I was never the smartest guy in any room, anywhere, including the bathroom. And so, I saw some of these folks, not all, but a couple of them, they lose everything in a day. I mean, they're riding high tens of millions, hundreds of millions of dollars personally. They came over from Lehman. Their house was secured on Lehman stock. Lehman stock goes to zero. They lose their house. They get divorced. And all of a sudden you're like, wait a minute, you have the exact same net worth as me, which is, around zero. And watching that happen was a shock to the system because it caused a handful of things to happen. But the main one was I realized that my judgment is the only one that matters for a particular trade idea because everyone's fallible. And to some degree or another, we're all groping in the dark. And so that was seared onto my prefrontal cortex forever and ever. I had to do the work. I had to agree with the trade and I had to put it on and own it. Because I saw just incredible people just, get fired in half a minute or lose everything in half a minute. And so, I thought that was, remarkable that the mark to market is the only true purifier and the only true objective judge. Like, I like to think my wife's objective about me. She's not, the only thing that's really objective, it's not your relationships. It's something like that. It's the mark to market. And so, watching that was, a really big deal. And I think, a lot of my friends that aren't in finance are like, what's the big deal? All you can lose is what you put on and you can make within a certain probability, a certain amount. And like, yeah, that's true-ish. If you have an options positions on, you can lose a lot. Like ask the Porsche VW folks who got crushed. Ask LTCM, the smartest guys in the room. Ask, this happens over and over again. Ask anybody that's actually in finance. And the difference is your emotions aren't finite and aren't probable. Your emotions are more like, in physics or in mathematics, when you're stress testing a theorem, and so you test it at the limit, which is negative infinity, positive infinity, and zero, to see if the theorem holds true. Your emotions are like that. So you might lose 1% or 20%, but you're going to feel like negative, infinite, bad emotions. You might make 1% or 10%. If you're new, you're going to feel, elated as if you just conquered the world. And so I think the ability to manage those emotions in a system designed to make you feel them at the extreme is quite important. And for me, that means that I only look at things that are monopolies and oligopolies. It means that I will not lever unless I see something that I can knock out of the park. And then I have very strict risk limits as to how much of the portfolio it can take up in terms of size. I'm never going to take something that will put me into stock that's 3 times my portfolio or something like that. Or in the case of venture capital, it means that I'm trying to find the very best company in a specific category, trying to help the entrepreneur out and making it a very big, concentrated 10% position in the portfolio, never having more than 10 to 12 names. And to get back to the risk piece, for me, that's because if you diversify a little too much, and for me, that's more than 12 positions, you're effectively, it just shows a lack of confidence in the process to me. And it shows a lack of confidence in how you handle adverse situations. And if you are blessed, let's say in venture, to not have a mark to market, you better do all the work possible. And you better have the most top flight company so that since you can benefit from no mark to market, in COVID, if every venture investor had a liquid market that they could eject, they would have hit eject, but they didn't. And some of those companies are now, 10x, 20x, 30x. But the market doesn't treat everyone the same. The liquidity from the Fed doesn't treat everyone the same. And you really need to put yourself in a position emotionally where you understand how you're going to react at every phase of the market and how you've reacted in the past and structure as well.
Yeah, so much to unpack there, because that was the other conclusion I came to as I actually started running money. And you realize that you can simulate everything. By the way, I advocate doing so. I wrote a piece called The Thinker and the Prover, and it takes you through. My grandfather taught me a thing which he called premeditating, which essentially is, okay, so here's what I want or think I want. What happens if I get it? Good, but also bad, right?
Yeah.
What happens if I don't get it? Bad, but also good, right? And so it's a great way to clarify your thinking. But the more I dove in, the more I saw that, the 4 horsemen of the investment apocalypse are fear, greed, hope, and ignorance. And only ignorance is something that you can address. Fear, greed, by that I mean without trying, right? You can address ignorance through learning, through talking to people smarter than you, et cetera. But the ones that you can affect, but it's really hard because you got to figure out your own emotional makeup, are, fear, greed, and hope, right?
Yeah.
And so the deeper I got, the more I understood that it really is an emotional question, and the immediacy of emotions and the way they're asynchronous with the way that we should behave, right? So like Proust, I'm going to blow the quote, but the essence of his quote is, driven by feelings that are destined not to last, we make our irrevocable choices. And like, that's what it's like to be in one of those Lehman moments. And, during that whole crisis, so my solution was to be a quant, right? Like, so the only emotion that I had to control was not overriding our models, right? And so after I retired from OSAM, like that, somebody asked me, like, what are you most proud of? And I said, honestly, what I'm most proud of is that I never overrode a model emotionally. Wow. And during the crisis, my head of research used to come into my office every morning, say good morning, right? Like, hey, Jim, how are you? And I'd be like, fine. And well after the crisis, at a dinner, he said to me, I have something to confess to you. And I said, what's that? He goes, remember during the financial crisis, how I came into your office every morning and said good morning? And I went, yeah. And he goes, I was doing that because I was so fucking freaked out about what was going on that when I walked in there, I heard Bach playing. I saw you were very calm. He said it literally brought my own temperature down. And so like, but that's not right for a lot of other people, right?
Right.
One of the things that you also mentioned, this, and my friend George Mack talks about a lot, the increasing the surface area of luck, right? So you mentioned, you get put in charge of this ridiculously big book at age 24. Like, a lot of people would make them crumple, right? It's like, I've seen traders literally that can't do it. They can't push the buy or sell button just because they're so freaked out about what is happening to them emotionally that they can't do it. But I think that the calibration of one's own emotions is a good topic here, right? Because you mentioned several things that you did personally to do that. But like, if you were coaching somebody who, you found to be super bright, very sort of suited to this world, like, where would you start? Where would you start with your questions of that person to kind of calibrate their risk tolerance yourself?
Oh, well, there's two parts. I'd zoom out and I'd really try and suss out how they felt about their partner and how they felt about their choice of career. That's step one. My aunt is a psychiatrist, and she used to tell me when I was a kid all the way through to today, she's like, there's only two choices that matter. Who's your life partner and what is your career? Because, one could be bad and one could be good, and you have a good life. If both are bad, you're in hell. And if both are good, every day you're walking in heaven. And so if I understand kind of how they're feeling, how they are on an emotional level from a big picture standpoint, it gives you a little bit of insight into what matters to them and where their focus is. Drilling down, you can ask questions about them. I think if someone says they did a thing, you just simply peel back the onion and drill down until there's nothing there. And you quickly find out, was this a guy who worked at, pick a generational company, a Stripe or a SpaceX or a Goldman or O'Shaughnessy Asset Management? Did you just have a Patagonia with the logo said that name? Or did you actually do the deal that you say you did where you actually deployed X amount of capital into these companies? And so I think pretty quickly you can suss out where they are. I think too, you can ask obvious questions like, do they matter to them? If you say, hey, does money matter? I think it's popular to say money isn't everything. Money is the root of all evil, which is a misquote, obviously, or, things of that nature. But at the end of the day, there's this drive for a scoreboard and it solves multiple problems. Understanding the person's background kind of gives you an insight into, do they have a choice or not? Like, I mean, so much of it's driven by mimetic desire. And everyone in my class from Princeton went to, they went to Barclays or they went to Citigroup or whatever. So I'm here. Like, how much of it's real? And the more you drill down, the quicker you get there. Their willingness to admit mistakes, their willingness to take full accountability and say, I'm wrong. It is shocking how hard it is to get people to say those two words. But I really drill down there. And then I drill down into, do they want accountability? Because everyone says they want a meritocracy. The reality is every human wants leadership, but they don't necessarily want meritocracy. And so depending on how you structure their compensation, you get to learn a lot about whether or not they really do want to eat what they kill, or whether maybe they want to do that, just not yet, they're not ready for it, or if they want something else entirely, or if they just want to cruise. And so I think learning about their views on where they're headed, learning about their views on partner and career, is it a function of mimetic desire? Are they kind of on autopilot on some of these bigger background choices? Learning their expertise by saying, okay, and then tell me about this piece and then this piece and this piece, and finding where the dead end is, learning their actual quantitative rigor, and then learning like their views on compensation and accountability. That matrix kind of is, that's essentially the bulk of the hiring matrix we use at our firm that I've always used. But I think that gives you a very good picture of where they're at, kind of on a mark-to-market basis, as it were.
So as I listen to you, like, I'm ticking off in my brain, you're looking for people with high agency, accountability, who are sort of the least affected by mimetic desire, which had its moment a couple of years ago. You know, lots of books. Peter Thiel's real big on mimetic desire, and Rene Girard. And I studied him for different reasons, but then found how applicable they were to like the market. And I love your idea. For example, one of the reasons why naming my companies is simple is because when I started my first company back when I was 27 years old, speaking about having a great life partner, my wife, now of 42 years, said to me, because I had this long list, right, of Macromite or, New World Invest, just horrible names. And she looked at me and she goes, Jim, do you really believe that you're going to succeed at this? And I'm like, yeah, of course. I wouldn't start it if I didn't believe that. And she goes, then put your fucking name on it. The only way that you're going to absolutely do 100% burn the ships is to put your name on the company. And I'm like, wow. And then, of course, I started immediately looking at all the old school firms, right? They were all named after their founders and partners, right?
Yep.
It was like JP Morgan was a guy. Merrill Lynch, Pierce, Fenner, and Smith were guys, right? And so, but that just cut through so much for me when she said that to me. And it's kind of like, duh. So I found that to be incredibly helpful because you're not just putting skin in the game, you're putting your soul in the game. If you put your name on it, but then your other comments are also equally true. It's like one of the things when I'm working with younger people who really want careers in finance, like I will explore getting them to the point of saying I'm wrong or I don't know. And like the best things in my life were opportunities where I was wrong. And I didn't know. And just being able to say, I don't know, let me find out. And that leads to a view on how people look at mistakes, right? So I view mistakes as portals to discovery and growing my mental models. And a lot of them are going to be completely wrong. And there's nothing wrong with that, right? In the age of Ptolemy and his astronomy, guess what? Completely wrong. Very useful, very useful for guiding those early ships to discovery. But, along comes Copernicus and you got to change your outlook. Do you look for that too? Do you look for an ability to, in kind of real time, because you like mark to market, like in real time for somebody to say, hey, Ateet, I'm fucking wrong. We got to change this.
I mean, I love it if they're that thoughtful that they can say that. That's huge. It tells me a lot about them and it allows us to then address the situation at hand. How many people do that? Very few. That's probably why, in a year we've hired 2 people, 3 people. It takes a long time to find these great people. But you're right. Mistakes kind of purify everything. They refine the process. They iron out the wrinkles in your worldview and your risk management system and whatever it is you're working on. And I mean, I don't know. Stan Druckenmiller's right, like 55, 60% of the time, and he's the greatest trader in history. So, I mean, you don't need to be right every time to dominate or be fabulously successful. I think you just need to be really good at kind of cutting and either going to the sideline or reversing. And not everyone can do that. Like if you can't reverse a position, then just go to the sideline. That's just, it's just a lot better than bleeding. I had a boss named Wayne and an instrument I was trading was at like 90, 91. And I wanted to buy it at 90. And then it went down to like 88, 89. And he goes, did you buy some? And I go, no. And he goes, oh, good. Well, you can buy some now. And I was like, well, and he goes, well, let me get this straight. At 90, you like it. Your conviction hasn't changed. At 88, you don't want to buy it. And I go, no. And he goes, at 89, do you want to sell it? And I go, well, no. And he goes, okay, well, what good are you then? And just walked away. That's kind of, it graded up. Like you have to get in the game and that's normal. And yes, you will make mistakes. Like just step up to the plate and make them. And figure out what your analogy is. Like so much of learning, it's for a lot of people, it's visual. Sometimes it's audio. Figure out the thing that allows you to make the mistakes with regularity, so that you can just get on with it. So like a buddy of mine said to me, he used to play baseball, and he's just like, yeah, a lot of pop-ups, but then every now and again it's single or double or whatever. And pop-ups, as someone who is objectively awful at baseball, that really kind of resonated with me. But whatever it is that resonates with you, that gets you to get on with it in the right way, I think is really critical.
Yeah, and the sports metaphors are legendary, right? Like I just read a thing the other day about how many shots Michael Jordan missed, right?
Oh,
and the number is massive. and Babe Ruth, number of times he struck out. It's so funny because I think our human OS guides us towards only looking at the one side of the ledger, right? Like people, it's like, no. You need to look at the full history of, in the case of sports and an athlete, but in the case of markets, the trader or the investor. And, one of the things that I was just talking to some of my colleagues at O'Shaughnessy Ventures yesterday, and we were talking again about the financial crisis in a different context. And one of the rules that I had when I was at OSAM for everyone at the firm, starting with me, was we don't call people when we're killing it, right? Because like when we're killing it, they know we're killing it. They don't need us to call them and say, hey, look at how good we're doing. Look at how smart we are. However, the rule was, when we are absolutely getting the shit kicked out of us, everybody's on the phone. Everybody is on the phone to our clients because that's when they want to hear from you. And I had one guy, I still remember, again, it was during the financial crisis, say to me, you're the only manager who is called incoming.
Yeah.
And then he told me about his frustration without being able to get other managers online. And like, again, to me, those simple things orient you, I guess, and the firm to understanding, like, it's hard. I mean, obviously nobody, when let's say the market itself is down 30 and your stuff is down 45 or more, right? And there's this huge delta. It's not natural to want to call the person whose money is down way more than it would be if he or she had been in an index fund. But that's the time to call them.
That's how you build trust, right? I mean, I don't understand. They're not stupid. They know exactly what's happening. What they want is to know that you know exactly what's happening. And if you're not calling, then there's a real problem there. And it, it breeds insecurity because it shows incompetence, and that's natural. You do want to over communicate. It's funny. I do think everybody should trade a mark to market book and feel accountable to themselves for a long time to really, just beat the whatever it is inside of you that thinks they're better than everybody else. Cause we all have that, right, to some degree or another. And just to make everything humble and nice and smooth again. Right. Like, I think that's really critical. That's funny. No, I think, your clients see their statements. They know when you're making money. They're all right. You pick up the phone when they call for sure, but you definitely pick up the phone if you need to alert them to something.
Yeah. And like, let's not kid anyone. Anybody who decides they want to come to the world of Wall Street, like when I became just infected with that bug, I was still a teenager. And like before she was my wife, she was obviously my girlfriend. And like, she's like, why are you so obsessed with markets? Yeah. And I'm like, it's the Olympics of business. It is like markets are, I mean, they're just endlessly fascinating and they can have endless outcomes. Right. And so it's just like this great puzzle that I was really interested in trying to figure out, because they touch everything, right? Like we started our conversation about how you've got to calibrate yourself emotionally, right? Because that is what's really driving things. I'm a huge fan of the, I guess I don't know what I'd call him. I guess the Enlightenment author, Jed McKenna, who himself, that's a nom de plume. And I always joke that the author, created the fictional character of Jed McKenna to tell us we're all fictional characters. But a friend of mine, Dan Jeffries, who's a technologist, wrote a brilliant essay, a couple of them, on Jed's work. And one of the things that he found was who is the closest to reality, right? Like the way shit really is, without your fantasies, without the way you want the world to be. And he lists the following three. The first are emergency room doctors who like have to make a life and death decision immediately. The second, special forces. Yes. Special forces are like, they can't have delusions. They have to have the best map of reality as it exists right in the here and now. And then the third one was the one that surprised me. Traders. He said, basically people who trade billions and billions of dollars, like he loved them because he goes like, they are the closest to reality and they have very, very few illusions, good ones at least.
Yeah.
Right. And you know, it reminded me, he's got a great quote, which is, if somebody comes along and doesn't buy your fantasy narrative about having a tea party for Lord Lion and Lady Gazelle, maybe they're not mean, and maybe your fantasy narrative is just a little bit fragile. And you just see so much of this today, right? Like these fantasy narratives that just make you shake your head and like, how do you maintain these with like the best thing that happened to me was let's step back. The worst thing that happened to me, I was originally interested in trading options. Yeah. And the fatal thing happened. My first trade, I doubled my money. And I am God's gift to markets. I will soon be a multi-billionaire. And then, of course, the market kicked the shit out of me for the next several years. And it's like, I am pretty convinced, no matter what your level of abstract intelligence, no matter what, like how clever you are, however good your ideas are, you need to be made humble by the market. Yeah. Because if you're not, you're going to get, you're fucked. Because ultimately, and like, I have it like tattooed on my brain. If I think one thing and the market thinks another, I'm wrong. Right. And so that simple thing, it's really hard for people to get to. No?
I mean, that's absolutely right. A lot of people thought Wayne was very direct and abrupt with me. And one of the guys was like, man, he really goes after you. I'm like, actually, I'm fine with that. We're actually talking. We're communicating. He's preventing me from making bad mistakes. It's just one of those things like everyone thinks because they're good at one thing, they're good at everything, right? And as humans, we have a tendency to believe that. And so the difference is like, I have doctors in my family. Does that mean I can go into a theater of operation and conduct open heart surgery? No. I've read books and contracts. Does that mean I can go into the courtroom and defend somebody and understand the legalese and procedure? Absolutely not. But in the market, you just literally have to sign a document to wire the money in, and you're good to go. You're playing against the Michael Jordans of the space. Like you're literally squaring off against Druckenmiller and PTJ and, all those guys. And there is no guardrails. It's just you on your own trying to figure out reality. I think that's a great hierarchy of folks. I'd add one more: pilots. You can't just, fake being a pilot. You kind of have to know how to land the plane, take off. You can't just decide to maybe or maybe not run into the mountain. You have to be really good at it. And so I think that's another one. But, even some of the guys I've worked with historically, some of the best guys and girls were special forces operators. They can cut a position with zero remorse, zero thought. Oh, I'm going to go to the gym now. Like, dude, you're down like 3% today. Like, okay, yeah, I don't care, dude. I'm going to the gym. I've seen bigger things than my 3% P&L. And so I think that's a really good one. It's very important. It's also, it puts perspective on things as to where where you stand, because some things are not linearly difficult, they're exponentially difficult. Right. And as traders, we're kind of on the bottom of that totem pole and get to have the most fun. But nevertheless, it is interesting to see, like I said earlier, your emotions will range from negative to positive infinity, unless you can really control them and bind them and understand how to channel them. And most people you're never forced to do that. Right. Yeah, I'm curious about the gentleman that you talked about before that couldn't push the button to buy or sell. I wonder what his background was, because there's no defined background, like the old "give me a poor, smart, and hungry." Yeah, that does work most of the times. There's a reason that saying is popular, but I've seen a lot of insanely wealthy young folks that want to make it on their own, that want to prove that they're not there because of their mother or father or whatever. Work just as hard and do just as well. So there's no one template, but certainly there's a lot to find out about oneself.
Yeah, that's another great quote about the market. If you don't know who you are, the market is a very expensive place to find out. And and again, it's that reality. And like your boss, Sir John Templeton he knew his own limits. I remember reading an interview with him, and he said that he would often put bids, good till cancel bids on stocks that he loved way below where they were trading. Like if it was trading at 100, he would put a bid in at like 20, good till cancel. And they're like, why do you do that? And his response was beautiful. It was like, well, because I know that if the stock ever actually gets to 20, I will never, ever, ever have the emotional fortitude to push the buy button.
Yep.
And so his way of dealing with it was to do that, right? And that's what I love about when you study like some of these great investors and traders is they figure out the right way that's going to work for them. And it's different for everybody, right? So for me, it was like, okay, I know that I'm running human OS just like everyone else. I'm probably not any better or any worse, probably somewhere right in the middle of that fat bell curve as to how I react to emotions. So what can I do? Well, I can neutralize them by being a quant. And of course, I was drawn toward algorithmic investing anyway. How have you noticed the changes of your history of trading? What has ported over toward venture in terms of the way you think? Do you have different systems when you're looking at venture investments, which by their nature are much longer term?
Yeah, I think I want to. Intellectual stimulation is kind of one of the key benefits of both career paths. I think in venture, everything sounds sexy at seed. Jim, we've got this chocolate that cures cancer and it can grow in any climate, this cocoa bean, and you can just, harvest it immediately. We got this laser that loosens up the gravel or whatever you call it, the moon dust, and it creates diamonds and we're going to bring them back. Like there's all sorts of things that sound incredible. I know that's not for me. Micro caps are not for me. I want the big liquid, blue chip tickets that I can trade options on that are going to be here forever, or the guys that are creating a new subsector where I think they'll be the winning player, regulatory advantage, IP advantage, whatever the case may be. And so that ports over in terms of my mindset. I run a concentrated portfolio that ports over the fact that, I know this about myself. Like I've got guys on the team that work really smart. Like if they wanted to, they could only work like a couple of days a week and they would do just as an incredible job if they worked all 5 days a week or 7 days a week, actually, technically for us. But, I'm not that guy. I know that about myself. I have to leave no stone unturned. So I'm going to read everything about that. There's 400 items in the data room. I'm going to go through every single one. I'm going to go through every line of every spreadsheet until I feel like I've internalized this and well in advance. I'm going to go visit the factories on the ground in Chicago or Wichita or wherever. I'm going to talk to your suppliers. I'm going to talk to your clients. I'm going to talk to, if you have government contracts, I will find out who you have them with and how those are going because of our connectivity within the Department of Defense. And I go through all of that. And you can do that in the publics, but in the privates, I guess what's different is they don't have to give you information. So you have to figure out, why does this board member, CEO, CFO, current ex-employee, whomever, why do they want to give me information? Why do they want me to participate on the cap table? So that's very different here. The other thing that's different is, how am I going to help them? Like, Satya Nadella is a stud. He does not need my help with literally anything other than passing time with good conversation, probably, right? And even that's debatable. He doesn't need my help. But in the private, some of these CEOs, you can actually help them. And it's a lot like Christmas, where sometimes I might get you the gift I want, not the gift you want. And what's really great about venture is that sometimes they want silence. Just do help us out with this one thing and go away. Sometimes it's, hey, we have this huge project. You need to come on for 6 weeks and really help us dig into the nuts and bolts. That would never happen in publics. The fact that there's not a liquid exit or entry is very interesting in privates. I traded CDS when CDS was 10% of the bond market, en route to 500 times the bond market. So understanding how to trade liquid assets at scale is very important. And I think one of the key lessons from that is game theory. Who are you up against? I don't know a single asset class other than venture capital where somebody would tell you all their positions, post it on a website. It's the craziest thing to me even now. Whereas, and you're advertising to the entrepreneurs, I get it, but it's also kind of weird to me. Whereas in the public's like, I don't know what Millennium and DE Shaw and, Stand Dry, I don't know what they're holding. I can look at regulatory filings in certain cases, but it's on delay. And you kind of don't really know, it is a delta versus an option. What is it? And that's very different here. It's very, very different than in the public market versus the private market. I'd also say that those same lessons still apply as to how do you analyze the company, the financials. And like I said, I don't do seed. So what actually fits my emotional constitution, what has delivered me consistently high returns, it's the valuation of 100 million and up. So half of what I do is probably 100 million to a billion in valuation. The other half's a billion and up. And I'm always constantly thinking, well, at 100 million, that's an arbitrary floor, more or less. But at that point, you've got a real income statement, a real balance sheet, cash flow statement. I can do forensic accounting. I can talk to your clients. Below that, I'll fall in love with the story. And I'm not a story guy. It's all just a number on a screen in Publix. In venture, it's not that. But at that valuation floor, you do get real numbers that you can then start to marinate over and see where you can be helpful, if you can be helpful, if you like the company, regardless of the degree to which you get involved. And how it complements your portfolio. So there's a lot of really big differences, but the behavior, the understanding yourself, the emotional constitution required for it, the accountability, that all stays the same. That foundation is very consistent. But it is kind of interesting. I think the mark-to-market experience is so important. The fact that you really understand how to manage up, how to manage laterally. You understand that there are no heroes. I don't want to get in something just because one of the best firms in the world is involved in the venture side. Why are you even seeing it then? Right? There's a degree of negative and adverse selection that people trick themselves into getting involved with. So I think there's a lot of lessons in publics. I think you have to go public to private as opposed to private to public. But I think there's a lot of lessons to be learned and applied. I think the game theory part is so huge. You have price action in publics. That tells you the game theory embedded within it. In privates, you have a cap table. The top 35 funds run 70% of the dollars in venture. If one of those top 35 are not on your cap table and you have a CapEx heavy business, let me tell you right now that if the cycle finds you, and it always does, you're going to have to take wild amounts of structure, dilution, aggressive cram downs, whatever. And so, that's a very different world to a public market, right? And so you have to really think, how am I going to work with these 35 folks, these 35 firms that are illustrious and have decades-long, multi-decade, generational kind of returns, some of which are new, but still have that gravitas. How am I going to work with them? Because venture is a rising tide lifts all boats economy. It is not a zero-sum game like publics are, quite obviously, or real estate is quite obviously. And so I think you really want to understand who are the players you're up against or working with. Because if you don't respect the people that you're up against, you'll get devoured. It's unfair. It's like a goldfish and a shark. And so you really have to respect the ladies and gentlemen you're up against and figure out how you're going to work within the frameworks that exist. where that fits your emotional constitution, and how to really respect like their past investments and how they've reacted under pressure. There's so much of this business, like it's me understanding the competition and how they operate. Are they likely to put lick pref on? Are they likely to put, options, warrants, structure? Because we trick ourselves a lot in this business. It's an up round. Great. Why does it have structure on it then? Half the deals this year, 54% of the deals this year so far and last year have had structure on them as up rounds. Okay. Why do you need structure if you're doing well and have momentum and it's an up round? It's a synthetic up round. It's a down round by any other name. So I think you really need to understand who you're up against, the terms of the trade, the different permutations and expression of the trade, secondary, primary, preemptive, primary, notes, structure, all that. And in that way, it's very similar to publics. You really want to respect the process and have a really great risk management system that gels with your kind of emotional constitution. But I don't know. I could go on about hundreds of lessons from publics that have applied here.
Yeah, I had a similar where the lessons from the public markets were invaluable. But when we started in private markets in about 2006, my basic strategy was, if I'm seeing a deal, it's so bad, it's so horrible that I can just pass on it. But I'm like, but I want to see these deals because I want to learn what a horrible deal looks like. And so, like, via negativity, I learned a lot, right? Like, I agree with your statement that at seed, which we do seed, by the way, because of, the way I'm built, it is very attractive and interesting to me. But you're right. At seed, everything like looks fucking unbelievable. It's like, wow, they're just, they've discovered how to turn the moon into cheese, how to make that cheese transportable back to the earth, and they've solved hunger. I mean, what is the TAM for solving hunger? Like, that's amazing.
That's exactly how I see. I know that about myself because, quite obviously, personally, I lost a bunch in seed when I was still working at banks and hedge funds, and before I became an operator, and then before the asset management side. I know, again, just because you're good at one thing does not mean you're good at everything. There are very few Elon Musks out there that are good at a host of things. Most of us are very good. I'm good at growth and late stage. Very good at that. And so I don't want to go to seed and compete with you or Sequoia or anybody else down there. That's really funny.
The other funny thing, my son Patrick, who is the real podcast king, with Invest Like the Best and all of his other offerings at Colossus, he was very kind in that he named his podcast as kind of an homage to me, because that was the title of my first book, Invest Like the Best. And we were chatting the other day, and he's publicly said this lots of times, that the name he really preferred was This Is Your Competition. And it was with like these legendary investors, because he too was like, man, if you don't know who you are competing against, if you don't have know who they are, why they are that way, like you're the old adage about poker, right? If after a half an hour at the poker table, you can't figure out who the sucker is, you are the sucker.
Yeah. For me, that valuation floor eliminates a lot of stress. I'll tell you that, a lot of stress. And so that's kind of where I play. But at seed, the other thing is, I know this about myself. I like a high hit rate. My LPs like a high hit rate. So it's really hard for me to evaluate a seed manager in a world of zero interest rates up until recently, where I'm like, okay, yeah, you made 70 bets. One of them was Airbnb or Uber or Coinbase or Palantir, pick a great name. And the rest of them were zero. So how much of that was, the environment we were in with the most liquidity in the history of mankind ever, essentially in the US? And, how much of that was you? So hit rate kind of matters to me. That's something that you would look at in a quantitative context as a trader. Win-loss ratio, wins in a row, losses in a row, Sharpe, Sortino, all of that. You can't really quantify that in venture, but I do think hit rate still matters in venture, especially given the stages that I invest in. And again, for me, it comes back to what makes the most sense to me on the oligopoly monopoly part. in macro sectors with such aggressive tailwinds that you kind of have to really, really mess it up on purpose to not find something favorable. Like, I don't know if you ever saw the show, The Wire, where Omar,
love The Wire.
there's a scene where he's facing off against Brother Buzone and he goes, you'd have to hit me first. And Omar goes, this range with this caliber, even if I miss, I can't miss. And so when you have a great entrepreneur in a great sector with tailwinds, I mean, then it comes down to who am I up against? What's the structure? What does that look like? You know, where does this fit in the portfolio? How does that impact various correlations within sector specific themes we have, et cetera? I really think you want to find what is it for you that, you know, at this range and at this caliber, even if I miss, I can't miss.
Yeah, I love that quote. I love that show. So I know that we're not going to talk about any of your actual positions or your LPs, but what are you loving now from a macro view?
I really, really like robotics, manufacturing, and AI. We obviously, as a country, have offshored a host of mission critical jobs, both on, you know, our ability to print everything from basic machinery all the way through to, you know, the most advanced defensive technology. I think that's a theme that will continue: nearshoring, onshoring, friendshoring, all of that. You know, you see the CHIPS Act, the IRA, all of the different Inflation Reduction Act for folks who don't follow it, but all of those specific programs. I mean, if you hear Donald Trump in Bloomberg Business Week, former President Trump basically said, we need to get the dollar down so we have manufacturing back on shore. So I think things that are involved in manufacturing industrialization, particularly for mission critical products in various sectors, to me is very interesting. AI is very interesting, I think, to everyone for a host of reasons. Aerospace and defense for me is very interesting. Space is kind of a new frontier for, you know, it's always been a frontier for defense and commercialization, but it's having, you know, its fifth kind of renaissance, and a lot of capital's pouring in there. And thanks to SpaceX, you kind of have an ability to connect via their Falcon 9 and other offerings. You basically have a superhighway that lets you iterate the latest generations of R&D in very varied sectors, and also for defense. And so I think aerospace, defense, manufacturing, robotics, AI, we look at a lot of deep tech. We look at a lot of software as well. But those are the areas that we really focus on. And I think there's a lot that is getting done and that will continue to get done. Within that, we kind of have to keep a critical eye towards what's shifting on the macro side. You can't, on the one hand, look at, oh, there could be dollar devaluation, or, oh, hey, there's the IRA and the CHIPS Act. You also have to think like, well, what could get cut from the U.S. budget in a world in which the Fed is operating under fiscal dominance, where they're really operating to just fund the government debt as opposed to their dual mandate of employment inflation. They're kind of doing it, but they're kind of in a fiscal dominant situation. You know, Chair Yellen Treasury Secretary Yellen now, she shortened the duration of the debt twice. She's obviously front loading it in T-bills because foreigners are frankly balking at a lot of our longer duration debt. And we've kind of run out of pockets to tuck that away. I mean, we regulated it in with Basel III and supplementary leverage ratios for banks, but in a world where the banks can get hit via an FRB kind of SVB situation in May of 22, you really don't want to, May of 23, actually, you really don't want to find yourself in a situation where you're on the wrong end of that curve. And so we really think about, well, what do we like? What is the macro picture? Where will the U.S. government be forced to cut, and what kind of volatility could that induce? And then what does that mean for everyone on the cap table as well? Like we drill down to the various kind of permutations and game theory around that, but those are the sectors we really care about. And we're lucky in the sense that because we don't seek glory, a lot of the venture firms, a lot of the entrepreneurs or serial entrepreneurs will come to us with their ideas, and we're able to track them. A couple of the names we've done in defense, you know, we've been tracking them for 6-8 years in some cases 15. And so having that rich catalog, we're able to see when the cycle favors them, or when they've actually hit critical mass and have inflected. And when something's inflecting on those unit economics that are oligopolistic in nature, you really want to make sure that you're thoughtful there and that you're along for the ride. Not just, oh, hey, this sector sounds cool, but do the numbers make sense? Does the team make sense? And are they really at a place where they can do well? And so the sectors I mentioned, I think, are perfectly positioned for that for the forthcoming 5 to 10 plus years.
And what are the red flags as somebody who reads everything that's in the data room, right? And goes through every line of the spreadsheet and meets and talks to the customers and really meets with and gets to understand the founders and their team. What are the things where like your initial interest is on the macro view, which you just described, like it fits perfectly, and everything else from a 30,000 foot looks great. But then when you're in the data room, what are some of the red flags that others who are interested in doing this maybe aren't looking for that you find and use often?
We're always direct to cap table, and we're always fully integrated with management, with the C-suite. So a lot of that is in the data room, but a lot of that's also, it depends on the sector, depends on their economic models, but a lot of that you can get face to face. If I ask you a question and you answer an adjacent question, you think either I'm stupid or you don't know the answer, or you're hiding something. Like, it can be nothing else. And so how they answer the question, do they answer it? Do they skirt around it? That really matters. Hey, how many robots are you guys producing this year? If you don't know the number, like, there's a problem there. If you answer a different question about your production facility, there's a problem there. And so I think how someone answers the question, the degree of hesitation there matters. I think that a lot of the red flags we see is when I have to keep asking you for things that aren't in the data room, you're probably reluctant to show them, particularly financials. There's a lot of pro forma financials and games that are played there. When somebody joins the firm, there's a couple books that we make them read just so they can have a basic understanding of, like, I like to hire folks that don't necessarily have a pure form venture background. I want them to be real operators, or, to have a dimensionality that other venture players might not. I think venture is one where you can learn it if you've got like a rigorous background in something else, whether you're a scientist or an operator or whatever. So I give them those books, and there's some basic manipulation that you can see in a lot of pro forma accounting, which I think really matters. I also think that when someone says, hey, we're the Uber of X or the Airbnb of Y, like, no, you're not. Uber is the Uber of Ubering and taking cars from here to there. You are not that. Like, stop telling me that, because you're trying to anchor my perception on the most survivorship biased focused firm that you think I will like. And I don't like that. I just want you to just give me the facts. That happens. Usually I'm not, I'd say 99.99% of the time, I'm never the smartest guy in the room, but I'm certainly one of the most effective. And so I need you to answer my plain English questions as if I'm, 5 to 10 years old. And again, I do the same thing that I do for interviewing people. I peel back the onion. Okay, tell me about this. Tell me about this. And there's certain context clues within an interaction. If I email you and I'm going to give you money that you need for your firm to work, how long does it take you to get back to me with the answer? That's a big deal, right? Because capital is the lifeblood, certainly of my firm, but it's the lifeblood of all firms. And, if you're, I don't know, if you're Bill Gates or Jeff Bezos or Elon Musk, you can raise money just by saying, hey, and everyone will just chuck it at you. Like, you've earned that right because of your well-earned success for other people and yourself. If you're not that guy, like, you should be answering it quickly. So timing really matters as well. I ask questions about competition, see how they answer it. If you don't know your competition, I don't know what you're doing, frankly. And in the data room, you can see all of that. I found there's one founder where I asked him, I was like, oh, so tell me about the debt you have. Tell me about the interest rate and what you're thinking, right? Like, what are you thinking there? Like, do you want to refi it? He didn't know they had debt because he was a new CEO, but he'd been there for 12 months. Like, surely you have debt, right? Like, even if it's de minimis, even if it's a legacy position that's like 1% of your total capital stock, if you have it, right? Surely you've sat down with the CFO and poured over the books. And so I think it's more about the people there. One of my colleagues, she's one of the smartest people I've ever worked with. She does real background checks on people. Like, she can understand, like, this person was fired for cause. Here's what the cause was. This person is incredible. Here's what they actually led. She's able to discern by talking to people and fact checking. Do you just have the polo shirt with the logo, or were you the girl or guy driving the deal? And so I think there's a lot of that goes into it. And then, in the data room, there's always something about the clients. You'll ask like, hey, like, let me talk to a client. Like, you can verify the information. There's a lot of like basic stuff on the accounting side. There's a lot of rigorous kind of formulations. We build our own models. We sometimes will have folks that are experts in that sector, kind of will contract them to make sure that they can triple check my work and our analysts' work, et cetera. But there's a lot that you have to do there. And that's why I think on-sites are valuable. If you're investing in something, you don't know management, you've never been on site. Sorry, what are you doing again? Right? Like in a world with illiquidity in venture, you really need to be on it from a diligence perspective.
What are the books you give people joining the firm?
Man, I give them a lot now, but the first two are venture deals and financial intelligence. So like, books nowadays, I think publishers are like, hey, like, make this 600 pages so we can charge $60.
Right.
Those books are a couple hundred pages each, but every line matters, so I think that's what I give somebody that's a new analyst. And that's even for me, like, 15 years ago when I did my first seed deal, I was reading stuff like that. So I think that's very important for people. And then there's a host of stuff on different sectors. There's academic work. We have a self-development budget for folks on the team. Like, I had to learn how to code at night school at NYU when I was living in New York, and I had my company, so I could talk to the engineers so we could scale our business, et cetera. And I could understand what they were doing. I want these younger folks at the firm to have that ability because they care about compensation, sure, but they also care about personal development. And that'll get them where they need to be in various sectors, because we're a generalist firm. You're not going to know everything from, biotech to aerodynamics. That's just not how the world works. So making sure that they get what they need from an online course or, whatever they need has to be made available, I think.
Yeah. There is a book that I recommend often by Peter Drucker called Adventures of a Bystander. And like, I've read almost everything Peter wrote. I really find the stuff he wrote on management incredibly boring and antiquated. But his book, Adventures of the Bystander, I love because it's basically character studies of people that he met, and he met some really extraordinary people over his lifetime. But the one that's germane here is he worked for an old school merchant bank in London in the 1930s. And the guy who was the head of it, Ernest Friedberg, was old at the time and had brought in these younger brothers to run the firm on a day-to-day basis. And one of the things I gleaned, first off, he's a fabulous character. He would be great in fiction, right? But one of the things that I really gleaned from it was that fits with what you're talking about is the brothers got really enamored of this guy that everybody in the city was putting money with. This was the best thing in the world. They were so excited because they were a small firm. They were so excited that they got invited because it was all of the blue chip names in the city of London at that time. And so Friedberg decides to sit in on the presentation. And afterwards he goes, "We're not putting a dime with that guy. He's a liar. He's a fraud." And they're like, "What the fuck? He's been vetted by like the most important players are all backing this. You're insane, Mr. Friedberg. Why are you saying that?" And he said, if I'm getting this right, I haven't reread it in a while. He looked at them and said, he came in here with answers to every single question that we could possibly have asked. And he goes, an honest man wouldn't need to do that and would say, "Oh, that's a great question. I don't know the answer. Let me get back to you on that." Just that simple observation, right? You came in here with answers to every single question, right? And it's like, oh yeah. And then like when you apply that, when you're talking to founders, I bet it instantly hits me. Like when I meet somebody like that, right? It's like, aha, Ernest is telling me to pass on this one.
That's actually a great point. I mean, there's things that from being a human being and walking this earth and talking to people that you can apply quite That's pretty amazing. I keep drilling down into, tell me about that. Oh, you ran that book? Tell me about it. Oh, you built that company? Tell me about it. A really good buddy of mine, Ollie, made the comment. He goes, yeah, he's the 25,000th top first 25 employees at Uber. Because apparently there's so many people that say they were the first employee at Uber, first 25 employees. I actually know one that was like the third hire and, whatever. But he gets really mad about that too. He's just like, dude, it's diluted my brand completely. And so, it's funny how people just can't say I'm wrong. I don't know. It's also like you're in a service business. You can't forget what you're doing. Like a lot of people, it feels good, like to be in finance. There's more capital involved. There's more autonomy involved. But like, what do you actually do? I ask this a lot in interviews. I'm like, what do we actually do here? And they're like, or who's the boss? That's a seemingly innocuous or even a trick question, but it's not a trick question. It's like the one gentleman I hired, he goes, well, I mean, God, you have a lot of bosses, don't you? He was like you said, we're focused on cash returns in a compliant manner for our LP. So I guess the clients are your boss. And he goes, you're always talking about, we got to go work for this entrepreneur, make sure we can help him with everything from asset-backed lending out of Japan all the way through to, an entree into the Department of Defense so he can sell to various procurement officers in the government. It's like, so the entrepreneurs are definitely, they're definitely your boss. And well, I guess we all have part of the firm. You give everybody carry. It's a really, good package. And so I guess you report to us because if I have carry, I have ownership. And if I'm an owner, you report to me in some sense. Like, I'm not trying to be rude. And I'm like, yes, that's exactly right. You're in a service business. You report to everybody. You need to really crush your ego or check it at the door because you will never, from like this moment on, be the smartest guy in any room you go into, even the bathroom. And so I think it's really telling when you have people, some of the best entrepreneurs in the world. I've been lucky enough to be in the room with them or on a conference call with them. And the humility there is really striking. And you really need to dissociate the persona on CNBC or like Bloomberg TV or whatever that they're giving an interview on in a public forum versus who they are in private and how hard they work and what they're actually doing. There's so much mythology around it. There's so much branding and marketing, but a lot of what they do, a lot of how the sausage is made, it's mind blowing how some of these folks work and how good they are. And I think like understanding, what is your job? Do you remember Forrest Gump, where the drill sergeant, Gump, what is your job? And he goes, to do whatever the hell it is you tell me to, sir. That is exactly right. Like, what is your job in as a venture capitalist? It is your job is to serve your three constituents, your three bosses, the entrepreneurs, your clients, and your colleagues. That is it. That is your job. And then within that, yes, you have to do a ton of due diligence. You have to do a ton of work. You have to do a ton of analysis, a ton of lunches and dinners and drinks and all of that, and a ton of favors for firms and they know you won't invest in. But it's a rising tide ecosystem. And you have to be in the information flow, and you have to be well thought of. And, that's another big difference to compare to traditional finance, right? Like, and it suits my personality better. Like, every one of us wants to make the people around us feel good. They, I guess some people call it people pleasing or whatever, but, venture lets you do that. It really does. And you can make a hell of a lot of money and do, and learn about the best technology and play the most supporting minor roles and being a part of that journey. But you've got to know what your job is, right?
Yeah. And the idea of the difference between the persona and the way the person really is, like I've been lucky in my life to meet a lot of like incredible entrepreneurs, incredible people in finance. And like there is such, for the most part, a gap there because everybody, like, we're the Uber of, right? That gets back to mimetic behavior and like, let's go for the easy metaphor, right? And you so what do? You attach your enterprise, however remotely similar, normally not similar at all, to like this anomaly that is Uber, and it's kind of like you're lazy. Right. It's kind of like, no, you are not that. what are you really? And it's just like, if you just keep asking that question and asking that question, you can tell when, again, back to my being lucky enough to meet all these people, it's like the different way that gets answered, right? It's just like so telling, right? There's none of that bullshit factor, and it's just so much more fun. I also like your idea, which we touched on earlier, about trust. A lot of people who don't understand finance, who like have never experienced the world of finance, be it publics or privates or whatever, like they give me their I'm actually shocked face when I say, you don't understand. Our business is based on trust, and it is based on reputation, right? Those two things together, and one feeds the other. And they're just like, oh, that's bullshit. Like, that's you're all just a bunch of used car salesmen. I'm like, it could not be further from the truth.
Well, that's actually an important point that they're almost making, but not quite, which is, what kind of salesperson are you? Because if you're in a service business, you are selling. And there's two types, really. There's, if we could be simplistic about it, there's the used car salesman, slick back hair, that can sell you like the used car for top dollar. If you're going to do that, man, you better be just you better have it all together. That's terrifying to me. I just tell you exactly what it is. I one LP, and he asked me questions, and they're usually one word answers: unclear, yes, correct, no, and then sentence explanation. And that's how we interact, because that's what the situation calls for. But I think if you're a straight shooter, you have to be okay with rejection, because if you're a straight shooter, we're in the rejection business. This is maybe a bad metaphor, but I tell everyone it's like dating in high school, or it was for me. You're going to ask 100 people out. They're all going to say no, right? Like, you just need one person to say yes. And that's kind of, you have to be selective, but you have to be okay with rejection. And that's okay, because why would a lot of people take it personally. Why won't they say yes to me? Like, dude, they have a whole life over there that you have know nothing about. Maybe they have a lot of illiquidity in venture since 2022, and they invested in certain people that have lost the money. Maybe the family business isn't doing well. Whatever the case may be, you don't know. It's also none of your business. But you do know that trust is a function of experience, and experience is a function of time. So maybe go in there with no agenda, be helpful, do your job. You're in a service business, and maybe in 10 years, they're a good fit for you. Maybe in 15, maybe never. But you will get something out of it, whether it's the information flow, thinking about like what somebody intelligent is on top of mind for them that maybe you should be thinking about. There's always something there. And I think in a world of instant gratification, in a world of very integrated communications, it can be very hard for people that were not born pre-internet to just do what it takes to leave no stone unturned, and just do what the situation calls for. That's the trade-off. These younger folks are infinitely smarter in age, like pound for pound, than I was at 24, 34, or whatever. But equally, I remember writing a letter to my grandfather and putting a stamp on it and a photo and envelope. And, you know that it matters. Business gets done in person. In the post-COVID world, a lot of people think, "Oh, just do it on Zoom. I'll hop on Zoom." I mean, we're on Zoom now, but if you want to do business, you have to meet people where they're at and address the actual need. Goldman taught me a lot, but one of the things that I used to do, I knew I wasn't at inception anyway. The first couple of days, I knew I wasn't up to scratch in my own mind. We all deal with imposter syndrome or whatever. That dude just made $100 million. That guy just did this. I'd figure out the 10% of someone's life that they hated, and I would make it go away. Just make it go away. And then I started doing a lot of favors with zero in return. And at first people are skeptical, but after a period of time, they're just like, "Oh, that's the guy. Every time I see him, I get like a dopamine hit. He is every time there's good news or there's he's just going to tell me how it is." And I think if you can do that, you really become indispensable on a fundamental level. And then if you actually go through you can actually add value on an investment basis. I mean, you're unstoppable at that point.
That also find the 10% that they absolutely hate and fix it for them. Like that's a great way to look at new companies, right? Like, are they finding those pain points and are they making them go away? Is it repeatable? Does it stack up, right? Like getting rid of people's pain, man, if you just look at things through that lens alone, right?
Yeah.
You can fit it to virtually, it doesn't matter the industry. It's absolutely universal. If you can find a company that is effectively, repeatedly able to remove the pain points for the end users, that is something that's very interesting, right?
Yeah. And if they don't have a 10% that they hate, I don't think they're an entrepreneur. I don't think they're doing it as an operator. I mean, it's such a hard, I've done it once and it is brutal. And I got lucky that there was an exit there at the end of the rainbow. But like, oh my God, that is hard. Everything is hard. And every fire comes to you. You're on 24/7. It's forced accountability in the most raw sense. And so I think if you don't have stuff that your fires you're trying to put out, then probably won't be investing in you.
Well, I'm getting the hook here from my producer. This has been so much fun, Lucky. I was so lucky to be able to coax you because, guys, it's folks like Ateet that you really want to be able to listen to. I've been after you to you should write a book. You should be doing all this. And you're like, Jim, like, I don't have time to do that because I'm doing this.
As we've grown quite a lot and scaled dramatically in the last year or so, I'll be able to start maybe talking about more stuff as time goes on. But I always want to check with my entrepreneurs and make sure everything's kosher for them.
Which is exactly the way that you should be doing things. Well, if you've listened to the show in the past, you know that at the end, we're going to make you the emperor of the world. And you can't kill anyone. You can't put anyone in a re-education camp. But what you can do is take a magical microphone, speak two things into it, and you're going to incept the entire population of the earth. Everyone is, whenever their next morning is, going to wake up and they're going to think that both of those two ideas were theirs. And unlike every other time they wake up in the morning with a great idea, they say, you know what? I'm actually going to act on both of these two ideas. What are you going to incept into the world's population?
Man, I'm going to steal like my aunt's thing that she told me. It's probably been the guiding principle in my life. It really matters who you choose as a partner, and it really matters what career you choose. You want people around you that aren't going to say, I told you so when you're low. They want to bring you up. And when you're riding high, they're not trying to snipe you and bring you down. They want you to go up. And I think so many people I've seen led astray. It's because they're trying to please people that will never be pleased. It's not about them. It's not about you. It's about them. So really focus on what you need in a partner and a career, because that's all you got is this one shot and this one go around. And then the second thing I really impress on people is you are in a service business. Karma is very real and you report to everybody. Like, people rise and fall every day. The guy who got fired now runs his own company. It's worth $3 billion. Like, the guy who had a $3 billion company, $30 billion company, is a fraud and he's in jail. Like, you really do want to take a karma heavy approach to life. And if you're living a life of service, that is not a negative thing. You're not demoting or demeaning yourself in any way. What you're doing is setting yourself up to be in front of the most opportunities and have the most enjoyable time with people. So I think you're going to figure out your career path, figure out your partner. And then the second one would be, you're in a service business, focus on the karma. If you're in the game long enough, it works really well.
Both of those are absolutely great. Well, listen, this has been absolutely a tremendous amount of fun for me. I hope that as you grow your company, that you'll have a little more time, because I'd love to have you back. But for now, thank you so much for coming on and sharing some really deep wisdom.
Thanks so much. I appreciate it, Jim, and I'll talk to you soon.